have published on the website. In this webinar, we are actually wanting to share some of our thoughts on the COVID-19 outbreak. So previously, the virus name was named as the 2019-NCOV. So just today, this morning, I think WHO has decided to rename the virus as COVID. So it's a short form for coronavirus disease 2019. Okay, so obviously, I think the most important aspect of this story are actually the human interaction. On all the people around the world, okay, being affected by this disease, and our hearts go out to everyone worldwide who has been affected directly or indirectly by the virus. Okay. However, in this webinar, we will actually put our focus on the virus likely impact on the financial markets. So that will be the focus of today's webinar. So without further ado, let me go through the agenda for today. First of all, we will actually take a glance at the current statistics of the COVID-19. What are the current status, the amount of infected people, as well as okay. Then after that, we will actually move on to some of the expectations. What do we expect from the market in the near term? After that, we will actually move on towards the some of the historical data. We will share some of the historical numbers with you guys so that you guys can have a better idea of what has happened in the past and probably get a better inference of what is possible to happen, what might be able to what might happen in the near term. Then lastly, we will actually followed by the recent actions as well as measures taken by the policymakers around the world. Then we will actually conclude or wrap up the session. Okay, so over here I've actually put down the latest data available compiled from the World Health Organization, WHO's situation report. So the red bar actually shows you the confirmed cases worldwide as of yesterday, and the green line actually shows you the daily growth rate of the number of new cases on a daily basis. So over here we can see that the number of confirmed cases has actually continued to climb. Okay. However, one encouraging sign is that the daily growth rate has actually somewhat plateaued or not stabilized around the 10% area. Looking deeper into the China cases, because most of the confirmed cases actually now originates from China. So we actually dive deeper into some of the data originated from China. So among all the reported infected persons, the number of severely ill people are still currently hovering around 15 to 17%, which is represented by the dark blue line. The light blue line is actually showing you the death rate, which means the fatality rate of the infected people so far. And currently what we have actually noticed is that the death rate is fluctuating, is still fluctuating around the 2 to 3% area, which is within the range that what we have seen so far over the past 1 to 2 weeks. Okay, so to give you guys some of our thoughts on what can investors actually expect at this point of time is that we think the case counts are likely to increase over the next few weeks. Okay, so why is that so? It's because due of the asymptomatic transmission characteristic. So for those of you who have followed the news closely, I think you know what this means. It means that a contagious person can actually start being contagious without him realizing that he's sick. Okay, so for instance, if I'm sick today, but the symptoms are not showing yet, I'm already contagious. Okay, so this means that it's very this means that it's actually very difficult for the authorities to identify or quarantine contagious individuals that are not showing symptoms yet. So this is actually in a very different context compared to SARS, because SARS is only contagious when the symptoms appear. So back then, when airports or even public health infrastructure people, where they start to monitor our body temperature and whatnot, they are able to quarantine the contagious people a lot more easily compared to these COVID-19. So as such, we think that the previous measures are likely ineffective against containing this virus, and there is a very strong likelihood that case counts are likely to increase over the next few weeks. So aside from that, fatality rate is also one area that people are paying attention to. Okay, current data is actually showing a fatality rate of 2 to 3% as shown earlier. Okay, but we think that it is very hard for us to draw a conclusion that death rates will remain there in the future. Okay, so this is actually our thoughts are actually founded based on what has happened back in the past. So to give you guys some example, back in 2003, when Taiwan first reported their first casualty in April due to SARS, the death rate reported back then was only 3.8%. Okay, so as more cases unfold across April or May, the death rate has actually peaked about 45% during mid-May. And eventually, it stabilized around 15% as of June, which is closer towards the 11% death rate of SARS that is being published around various sources. So similarly, in Canada, they also have fluctuating death rates. So fatality rate actually peaked around 38.5% in April, and eventually fell towards 20% in May, and stabilized around 17% in June. So putting all these together, we are able to understand that the fears that are being circulated around the people or even market participants, because there's still quite a huge amount of uncertainty regarding whether or not this epidemic is properly contained at this point of time. And markets have actually reflected the amount of fears that we have so far concerning the COVID-19. So the blue bar actually shows you the return since the virus outbreak, which is drawn from the last close price of 17 January. So as you can see, most of not all of the markets under our coverage have actually ended in a losses territory, with exception to US equities, Europe, as well as Japan. So on the US side, equities have actually managed to recoup their losses on better than expected earnings report coming from the US front. Then apart from that, we have actually put down some of the largest drawdown numbers of various markets since the virus have actually, since the news of the virus broke out across the globe. So notably, North Asian equities, particularly China, Hong Kong, as well as Korea, those that are closer towards the China's country, are actually the ones that are being sold down the most. Okay, so with regards to whether or not this will actually be a huge dent towards the economy, whether or not the coronavirus will actually cause a huge dent towards the global economy, is that we actually take a deep dive into the number of to the cause of death that has been published on one of the websites that are found available. So the top 3 causes of death in the world are cardiovascular disease, cancers, and lastly followed by respiratory related diseases. So the COVID-19 actually falls under the respiratory related diseases. So over the years, based on historical data, diseases related death rates tend to vary gradually over time. Okay, we will show you a slide that is showing this trend after this. And based on the research, natural disaster as well as terrorism-related deaths can vary significantly between years as well as countries, and often has pronounced impact on the economy due to their damage towards infrastructure and the time required for the economy to actually recover from all these damage. So over here, we have actually put down the number of deaths globally caused by the respiratory-related diseases. So since 1990 until the year 2017, which is the latest data as of available, you can see that deaths by respiratory-related diseases have actually fluctuated between 6 million to 7 million individuals worldwide. Okay, then the green line actually shows you the world GDP, the year-on-year growth of the world GDP. So some of you who have been following the markets closely, you would know that during the periods of 1998, we have actually gone through the Asian financial crisis. Year 2001 is actually caused by the deceleration of growth is actually caused by the 9/11 incident, while the 2009 and 2008 periods, the traction in growth was caused by the global financial crisis. So if anything, we can actually noted that the global growth rate is actually quite resilient against the number of deaths caused by respiratory-related diseases. Okay, why? And we can see that whenever there's a sharp drop or sharp declination in death, most of those are actually associated with fundamental change in terms of the economy, instead of the varying death rates by the respiratory-related diseases. Okay, so we think that it is very tough for investors to actually draw inference from the correlation between epidemics and global growth. Okay, having that said, we are still very cautious on the pace of case count for the COVID 2019. Okay, we think that if eventually this case were to escalate towards a global pandemic situation where we see a huge increase or exponential increase in number of case counts as well as death, we think that will actually threaten the fundamental aspects of the global economy on a greater scale. So till then, adjustments to investment portfolios may be warranted. Okay, so what has policymakers done so far? I think over here I've actually shared a piece of information with you guys. I think you guys are well aware of this also. WHO has actually declared a global health emergency on the COVID-19. Okay, so it is also known as the public health emergency of international concern. So a good thing that investors can interpret from this is that because of this declaration, countries as well as authorities are going to step up their preparation as well as prevention measures. Then also, thanks to the power of the media as well as social media nowadays, awareness is there. And I believe you guys have been noting that a lot of the people in the public have started to wear masks. There are more sanitizers available for the people as well. So historically, there's only 6 declaration of global health emergency. So back in 2009, the swine flu, followed by the 2014 polio and Ebola. 2016, there's the mosquito-related Zika virus, followed by the more recent one, Kivu Ebola, and the latest 2019 COVID. Okay, so we think that the escalation will actually help to further mitigate the risk of a global pandemic situation. Then looking back on China, which is the economy that is expected to be hit the most by COVID-19, what has the policymakers done so far? So at the beginning of this month, PBOC, the Public Bank of China, which is the People's Bank of China, which is the Bank Negara Malaysia equivalent in the Chinese economy, they've actually injected 1.2 trillion yuan worth of liquidity into the markets to ease concern of short-term funding as well as a shortage of liquidity due to the market stress situation. Then shortly after that, when market reopens on 3rd February after an extended holiday break, the policymakers have actually restricted share sales to prevent panicking sell as well as irrational selling on their share market. Then in recent periods, on Monday, the PBOC has actually provided an additional batch of special funding specifically towards SME as well as companies that are being affected by the COVID-19 situation. So some of these sectors will include your manufacturers, will include your tourism-related services, tourism-related sectors, will include your medical as well as the healthcare industry. So this batch of funding is actually being offered to these companies at a lower rate compared to the usual prime rate that are being lent out to normal companies. So in today's headline, President Xi has also vowed that China will actually remain very supportive in terms of their fiscal as well as monetary policy measures to make sure that the Chinese economy will be able to weather through the current uncertain period. Okay, so having gone through the context of the virus, what are the possible economic implications as well as what has policymakers has done so far, we'll actually now look at some of the historical numbers post virus outbreak in the past. So over here, we have actually put down the first one is actually related to SARS. So post SARS outbreak in November 2002, most of the equities have actually posted positive gains, which is over the 9-month as well as the 1-year period. Okay. Then within short term, I think investors can also notice that within the shorter period time frame, like let's say 1 month to 3-month period, at the point of time during the outbreak, there may be concerns over the impact of the virus outbreak to the global economy, and that is why these concerns are actually being reflected by the short-term negative returns of the SARS outbreak. So we can actually see a similar picture for H1N1 as well. So H1N1 actually happens in March 2009. Okay, within the 1-month period return, the numbers are actually less compared to the 9-month and 1-year period. So do note that within the 2009 period is actually a post-recovery period after going through the 2008 global financial crisis. So the return numbers here are actually a lot more stronger and will definitely be above average compared to previous other virus outbreaks. So the second last comparison that we have will be on MERS. Okay, so within 1-month period and 3-month period, you will also be able to see that return numbers are relatively weak compared to the 9-month as well as the 12-month period on the right. Then lastly, we also put in the Ebola figures, which has happened in December 2013. So at that point of time, we also note that over the short term, within 1 to 6 months, if not 1 to 3 months, the return numbers are generally weaker compared to 9 months and 1 year. So what are the numbers actually telling us at this point of time? We think that if history is any guide, okay, short-term market returns tend to be weak as sentiments were affected, businesses uncertainty continues to linger over the short term. Okay, but for period beyond 6 months, 9 months and beyond, we think that most markets have actually managed to recoup all these short-term losses. Okay, however, it is also important for us to note that returns are actually being influenced by external economic factors as well, which is quite dominant, especially for the year 2019, where the global economy actually gone through a recovery post 2008. So at that point of time, the recovery of the global economy is actually stronger compared to the fear of the influenza back then. So although it is impossible for us to isolate the sole impact of virus outbreak, we think investors should note that the economic impact or the economic fundamentals actually have more profound forces, or to say dominance on equity market or not global equity market returns over the longer period. Okay, so to wrap things up, okay, the research team is actually monitoring the progress of the case count very closely. In fact, on a daily basis, we actually compile the numbers from the WHO situation reports to monitor if there's any huge spike, or even in terms of number of infected people or death rate. Okay, so our base case is that the growth rate of case count, we hope that it will continue to plateau in the coming weeks, and the case count reported may actually trend lower moving forward. Okay, so the greatest risk is if the case count grows at an exponential rate, or the virus actually proves to be a global pandemic with a spike in death tolls, not only in China, but also in other countries, and these will actually be very detrimental to the economic fundamentals. Okay, then we think by then adjustments to portfolio may then be necessary. Okay, so at this point of time, we think investors should not really jump the gun and panic sell all their investments because of the uncertainty that is going on out there. Okay, so today actually we are able to see some recovery in terms of sentiment because China has actually reported the first decline in terms of the infected individuals. So markets are actually quite sensitive towards the progress of the change, and if you were to decide whether or not to invest today, tomorrow, based on the number of cases, it is very difficult for you to time the market so perfectly. So we recommend investors to stay the course at this point of time. Okay, so that is all that I have to share with all of you today. Okay, I believe you guys will have quite a number of questions now. Today, with me is not only myself, we have Andy as well as Sean from the client investment specialist team. Okay, so if you have any questions, feel free to post in the chat room, and we will try our best to address the questions accordingly. And do remember to mute your mics so that you don't have extra noise. We will give maybe another 2 minutes to see if there's any questions. If no questions, then we might end the session earlier today. Okay, any fund worth buying? Okay, let's take a look back at the market performance now. Okay, let's take a look back at market performance now. So in terms of the magnitude of correction, okay, we can see that China funds or even North Asian equities are the one that has been suffered the most sell down. Okay, so back in the end of 2019, we have actually mentioned that Chinese equity as well as Asia ex-Japan equities are actually our favorite when it comes to investment opportunities. So at this point of time, we think due to the sell down, okay, this equity market, Asia and China, has actually appeared more attractive at this point of time in terms of valuations as well as PE. So if you think that this is a pretty decent opportunity to go into the market, you may consider investing in these Chinese as well as Asia equities. But considering that we are still at a very uncertain period, okay, we will actually recommend investors to buy into the market progressively. Okay, so meaning to say that if I have 100 ringgit today, okay, I think the Chinese market is cheap and I would like to tap into some of these value opportunities. But due to the concerns, I will actually maybe invest 30 ringgit out of the 100 ringgit that I have now. Okay, invest progressively. So if let's say situation continue to worsen, markets continue to correct accordingly, then I might top up further. So progressively over the next 2 to 3 months, by carving out my capital into a few chunks, it allows me to actually average down if let's say the market continues to go down, and allow me to buy in at a lower price. So that is one of the ways that we actually recommend investors to do. If you like the market, like us, we like China as well as Asian equities, you can actually go in progressively into the market. Okay, we have another question. Is there any concern that the Chinese government is withholding some data on manipulating the data? Okay, on the ground, there are a lot of hearsays as well as whispers of various kind of stories that are ongoing in the market. Okay, but when it comes to assessing the market, looking at data, we can only rely on official numbers, and especially when this is going through WHO. Okay, we believe the numbers have accountability in terms of the numbers that they publish. So instead of making predictions whether or not the data is true or not, we will actually work on whatever data that we have from official sources, from proper sources, verified sources, and we will actually proceed to base our views accordingly. But having said that, if you are very concerned that, okay, eventually the Chinese government is doing a cover up, eventually the case count is going to, skyrocket, whatever, you don't go into the market. You don't go all in into the market at this point of time because there's still a lot of uncertainty. So back to what I've mentioned earlier, maybe start buying a bit, bit by bit, carve out your capital accordingly. Then if market continues to correct, you continue to buy in accordingly. So that will actually help you to manage your downside risk. Another question is, okay, in terms of investment strategy, which type of funds is the best value to invest? Equity, balance, or fixed income? Okay, at Fund Supermart, we always advocate our investors to hold a basket of asset class in accordance to your risk profile. Okay, so to put things simply, everyone should have a balanced mix of equity as well as fixed income. So if I'm an aggressive investor, okay, I will have more equity compared to fixed income because equities are able to allow me to tap into more capital growth opportunities, and my portfolio will actually be reflective of my aggressive risk appetite because I have more equity. But if I'm a retired investor, okay, I cannot consume as much risk as I could because I need the money for my expenditure, retirement expenditure and whatnot. Then I should have more fixed income. Okay, so if you are a balanced investor, you should have 50-50. Okay, if you are a moderately aggressive investor, you should have around 70-30, 70 equity, 30 fixed income. And if you are moderately conservative investors, you should have the otherwise, which is 70% fixed income and 30% equity. Okay, another question, is Europe and Japan and US expensive now? Okay, these three markets are what we know as the developed markets. Okay, within the three markets, we think US and Europe are the more expensive one. More expensive meaning they have limited upside potentials. Okay, their PE value, their valuations are a lot higher than their historical average, which limits your upside potential. We are actually quite we actually quite like Japan within the developed market space. So if you're considering to add some positions in developed markets, we think you may consider investing in Japan. So one of the Japan funds that you may consider is also a United Japan Discovery Fund. Okay, this is a small cap Japanese fund that gives you the domestic exposure towards the Japanese economy. TYC, will virus outbreak benefit healthcare fund? Okay, healthcare I think is quite a broad category in this sense, but if you're talking about the health science fund, I don't think so. Okay, because healthcare industries, they produce pharmaceutical products, they produce treatments, they produce stuffs that are based on research. So a lot of their earnings are actually based on all these products. So coronavirus, as of now, I think there's still no cure yet. So it is unlikely for them to be able to harvest any additional revenues or whatnot from the sales. Okay, but if you're talking about glove manufacturers, sanitizer producers, or even hospital services providers, they will benefit because people are consuming all this due to the increasing awareness as well as the usage of the health facility. Look at China is up close the city. What is the impact for the next 3 months? Okay, at this point of time, closure of the cities is likely going to restrict travels. Okay, it's likely going to restrict the flow of goods, the impact on supply chain. So the possible disruption that we foresee frontline will be supply chain. Okay, your manufacturing goods will be placed on hold. A lot of things cannot come through from China to China or even out of China. So that is the first thing. So export sector, okay, that are very closely related to China or deal with a lot with China, they are likely to be impacted. over the next 3 months. Okay, then apart from that, on the ground retails, which is your shopping mall, your walk-in foods, your walk-in shops, retails, clothing, whatnot, those will be impacted. Because even for Malaysia, I think during weekends, 2 months ago, I wouldn't even consider going to shopping mall on weekends because I'm going to have a very hard time finding parking. But if you have gone to supermarket or even the shopping malls over the past week, you can actually find parking quite easily because people are not going out due to the trying to avoid the public area. So if you're talking about China, retail, on the ground retail, as well as the manufacturers are going to get impacted, as well as tourism. Okay, these three will be the main hit. But having said that, we think that some of the impact can be absorbed by the e-commerce sector. Okay, because I'm not comfortable in going out to purchase stuff. I will rely more on going e-commerce, going online to get my necessities and whatnot. So that part will actually help to compensate some of these retail loss in retail sales. I hope that actually answers your question. And also do note that the Chinese policymakers are going all out in terms of providing liquidity and stimulus to help these sectors to weather through the current difficulty period. What is the FSM Managed Funds Plan? Okay, I think you are referring to FSM One Managed Portfolio. Okay, so for those of you who are not aware of this product, the FSM One Managed Portfolio is actually discretionary management service, okay, where we manage a funds of funds portfolio for our investors. So at this point of time, our fund manager is actually monitoring the situation quite closely alongside the research team. But at this point of time, we think that we will not actually jump the gun to perform any portfolio adjustments just yet. Yeah, we prefer to wait a more confirming signs of, let's say, a profound impact or notable impact or any possible signs of recovery before we jump the gun to panic sell everything and rebalance. So at this point of time, we are taking a wait and see approach. You mentioned to perform dollar cost averaging previously. Yes, I did. Can purchase China funds now or better to wait for another 2 to 3 months? I think if you really like China, it's a very good opportunity to start buying a little now, because it's very hard for us to predict, okay, tomorrow everything is going to turn better, the next week everything is going to turn worse. Yeah, so we think at this point of time, based on the latest market movements, markets have actually started to recover. Okay, if you look at the slides now, the blue bar, returns since virus outbreak, which is as of yesterday, a lot of markets have actually recovered from their lowest point. So I think that is one good sign. But of course, this is pending, barring any data that is upcoming. But I think if you really like China, if you really like the long-term growth story, you can start buying some now. Yeah, but don't go all in. And always remember that China is one of the most volatile market. And usually we will recommend investors to not put more than 20% of their capital into single country equities like China. Will PBOC easing cause China bond yield to drop? We think it is likely at this point of time. So apart from providing liquidity, I think the global hunt for yields is still there. Okay, so setting the virus part aside, taking a step back, looking at the broader picture, central banks are still quite accommodative. Okay, be it the Fed, be it locally, or be it Asia or emerging markets, central banks are still very accommodative. Okay, and as such, it is very hard for investors to find good yields, good yields. So people will still be on the hunt for bonds. Okay, so China bond is one of the decent avenues that people look at. So I think bond yields still have some tailwind for them. Which company now going for vaccine tests? Maybe can have exposure to fund having share in that company. Okay, this might be a good idea. Okay, but unfortunately we have little control over what the fund manager wants to buy. Okay, say for instance, I want to buy company A. Okay, and currently Fund A invests in, Fund B invests in company A. if I were to purchase Fund B just because I like Company A, it's not really ideal. It's not really an optimal decision because investing in fund ultimately provides you the macroeconomic exposure instead of the sole company exposure. And apart from that, it is very hard. Not very hard. It is impossible for us to control what the fund manager wants to buy and sell. So if I were to buy Fund B because of Company A today, what if tomorrow the fund manager decides to sell the Company A because he thinks that Company A has not good prospect and whatnot? So when it comes to investing in fund, we think that investors should be more focused on the macroeconomic stories rather than the specific companies. If you want to gain exposure to specific companies, I think the most feasible way and direct exposure that you can get is through the stock market. Okay, we have around 5 more minutes. Okay, we will try to answer as many as we can. Andy has actually answered you already regarding the sales charge. Okay. Okay, any more questions? Perhaps we will give another 2 minutes. Okay, what about gold? Okay, currently the interest rate environment remains quite low. Okay, interest rate levels are also expected to stay low for the time being. Okay, so we think that actually represents lesser opportunity costs of holding gold. Because bear in mind, if you buy gold, there's no corporate earnings for gold. Okay, there's no dividends coming from gold, and there's also no fixed income or coupons coming from gold. So essentially, you're holding the asset which is subjective to market's perception on its value. Okay, so usually when it comes to gold, we think that it is quite correlated with the interest rate expectation. Okay, so back in 2018, okay, that year was quite a bad year for equity markets, right, due to the US-China trade war, but gold didn't actually appreciate it. Why? Because at the point of time, the US Federal Reserve is still increasing interest rates. So from an investor's perspective, when central banks increase interest rates, it means that I need to forego a lot more of my interest income, risk-free income when I hold gold. Okay, but in 2019, when the Federal Reserve starts to lower interest rate, you also start to see gold climb healthily because investors now have lesser opportunity costs when they want to hold gold. So this year, if you are asking about gold, usually we don't provide views on commodities. Okay, a short disclaimer here. But if you are looking from an interest rate perspective, gold might have a tailwind. Yeah. When is recession? Maybe linked to Corona. We can't predict a recession, but as of now, based on the latest data released by the US economy, US economy's momentum has actually picked up quite decently over the third quarter and fourth quarter. Okay, so apart from that, the headline numbers, the front-end numbers, your job data, your employment earnings, your inflation, everything is still quite conducive or constructive for the US economy. So if you're talking about recession risk has actually declined quite considerably since August. It has actually peaked in August, but I think thanks to the Federal Reserve's willingness to being accommodative to the market, the risk of a recession is now lower as of now, and you don't see much of a concern now on the headlines. FSM Fund ranking shows tech fund is scoring quite well in year-to-date 1 month. How do you see it in 2020 and risk due to Corona? Okay, most of the tech funds that we are showing on the FSM website is actually US-based company. So chances are their revenues are going to be impacted. However, do note that these tech funds derive most of their revenues from online as well. So considering that they have a broad-based revenue sources, because they don't only have exposure in China, they do business in other parts of the emerging markets, in other parts of Asia, as well as the developed markets. So I think the impact towards the tech companies will be quite limited. But having said that, the tech sector is one of the most expensive sector now in the US equity market. Okay, so we think that for investors that are very positive on tech, they should consider looking at semicon sector. Because the uprising of 5G technology, the adoption or implementation of AI initiatives, all these will actually help drive demand for semicon, will actually help drive demand for E&E products, chips, QA and QC along the supply chain. So we think ultimately we don't have to really focus on who's going to be the biggest company in tech. We just have to make sure that the ongoing demand in tech is there. So we think looking towards the supply chain, which is the semiconductor sector, will be a more decent play compared to buying technology companies directly. So for investors who are looking to get exposure into semiconductor sectors, they can actually look to buy into the local small cap fund, which is the Eastspring Investments small cap. Any news on Trump's second round deal with China? Okay, currently there's no news yet. Okay, we think Trump is pretty tied up with all his election campaign as of now. However, if you're worried about the US-China trade tension, right, we think it is quite positive as of now. Despite having need to handle the coronavirus outbreak, China has actually continued to proceed with lowering tariffs on US goods, which means they are very committed to the trade one phase deal that is signed back in January. So if you are worried about the tension now, we think markets are more concerned about the virus now compared to any escalation of the trade tension. Okay, there are also questions on any strategies looking at US election. Okay, there's no particular strategies, but I can tell you what markets are pricing in now. Markets are pricing in Trump to have a second term. Okay, because within Republicans, there are no strong or prominent candidates that are able to replace Trump. Okay, so markets are actually pricing in that, and from an investor's perspective, his policies are pro corporates, pro businesses. Okay, as opposed to the Democrats, their policies are less friendly to business. They're planning to do wealth tax, increase corporate tax and whatnot. So if Trump were to lose out the election this year, which is not our base case, we think the markets will actually react quite negatively towards that. But as of now, we still think that investors can position accordingly based on Trump's election case, which means that the base case of Trump, we are actually holding a base case from Trump, and investors can position accordingly based on that. Unless we start to see the election polls starting to tilt favorably to the Democrats, till then we think investors are okay. Any effect we can expect from Brexit? As of now, it's still quite uncertain. A lot of the policies are still being put in place, be it from the Euro as well as UK. So uncertainties aside, the macroeconomic picture in Europe is starting to look better. Okay, that is why European equities have actually done relatively well in 2019. Oh, okay, last question on Indonesia fund. Why keep going down? We did spending shift to Jakarta to Kalimantan. Okay, we're actually still holding a positive view on Indonesia's economy as of now. In fact, we actually put up a new write-up on Indonesia, giving you some updates on the GDP tomorrow. Okay, the article will be available on the website. Okay, so the recent sharp correction is actually due to the negative sentiment surrounding the coronavirus. Okay, so for investors, they are keen to gain some exposure into Indonesian equities, which is the second largest, which is the largest economy in Southeast Asia. We think that they can take this opportunity to add some positions if they are keen on the long-term growth story of Indonesia. We will actually end this session now. Any questions, feel free to email us at investhelp.my@fundsupermart.com.